So thank you everybody for joining us again to another webinar organized by Princeton for everyone worldwide. We're very happy to have Thorsten Slock with us, from the chief economist from Apollo. Hi Thorsten.
Hello.
It's great. Today we talk about tariffs and what are the implications of the tariffs policies on the financial markets. So in particular we will address several questions. So the key questions is, what are the impact of tariffs on the real economy? Is uncertainty about the tariffs worse than the tariffs themselves? And we'll link actually then the tariff policy to global finance. Is the loss of the US Treasury safe asset status the exorbitant privilege the US enjoys? Or can the US actually run a permanent trade deficit as long as it runs the US Treasury as a safe asset? And should Europe provide actually an alternative safe asset if the US Treasury steps back? And the big question is also, the current tariff shock, will it be amplified beyond the shock itself through indirect effects, second round effects, and it can be like a Lehman moment, but then actually the shock itself fundamentally is not so big, but then the amplifications actually make it much more dramatic. So what are the optimal tariffs in general? So if you write down a model, the optimal tariff from a country perspective is typically not zero. There's a monopoly power you can exploit as a country. And of course, other countries might then lean against it and try to exploit their monopoly power. Then it becomes suboptimal. And that's typically a complicated game. The other question is, should you impose tariffs on upstream intermediate goods or downstream goods, which are then finally for final consumption goods? And typically, you don't want to impose tariffs on upstream and intermediate goods. You don't want to change along the production chain the relative prices of various goods. It's better to impose tariffs on downstream goods, on final consumption goods. And from a dynamic perspective, of course, there can also be tariffs to have some infant industry promotion. So you want to protect essentially your infant industry, a new industry, develop your own new technology or industry, and this way you want to go on. But in general, the uncertainty about tariffs is typically always bad. It's essentially a tax on the system without any revenue, because if you create uncertainty, you don't create some tax revenue, you just create a tax on the economy, on the global economy. But what I want to focus on today, and we will focus very much on the finance implications, so the link between trade, the real trade, and the implications on the financial markets, in particular also in the US dollar and the US Treasury. And typically, the current account and the capital account are connected. If you have a trade deficit or current account deficit, you have a capital account surplus, because people who deliver some goods to you, they get a claim against you. So it takes two to tango, as famously Madame Lagarde said many years ago. But the US enjoys an exorbitant privilege with US Treasury. It can actually, issue debt at a lower interest rate than the government debt. But it can also continuously issue some new safe asset, and then they can actually run a permanent trade deficit. So there's essentially, formally speaking, at the aggregate level, countrywide level, no transversality condition doesn't have to hold. It holds for individual agents in the economy. They have to pay back their debt. But a country can actually run a permanent trade deficit without ever paying it back, as long as you can issue safe asset, as long as there's exorbitant privilege. And then the question is, can you lose this safe asset status? Can you lose this exorbitant privilege of the US Treasury? So what is actually a safe asset? A safe asset is an asset where the value of it is not only driven by future cash flows, the interest payments and all that, but it's also given by future service flows. It helps you to overcome some frictions. And the best analogy of a safe asset, in my view, is essentially the safe asset is like a good friend. It's around when you need it. A friend in need is a friend indeed. So it's stable when you have idiosyncratic shock, but it's also stable when there's an aggregate when we move into risky times. So typically there's a negative CAPM beta. And there's also, it's also good collateral for these reasons. But if suddenly the safe asset status becomes questionable, then people will ask, it provides less service flow, and people will ask for more cash flow, for more interest rate. So typically when you move in risky times, the safe asset appreciates in value. But if the safe asset status itself becomes risky, then actually declines in value. And then the question is, what will the safe asset status, where will it jump to? Will it jump away from the US Treasury to some other asset, a crypto asset, or the German bond and so forth? Or will we move to a global economy without a safe asset? And that, of course, will lead to a huge welfare loss if we don't have globally agreed upon a safe asset. And that's a big question. If you ever were to lose the safe asset status on the US Treasury, where would it jump to, the safe asset status, or would it disappear altogether? And this would lead to a large welfare loss. So one thing you could say, now it's a time for the Europeans to provide an alternative to the US Treasury or substitute the US Treasury to some extent. And it's a time of the European safe asset, the SBIS, the European Safe Bond, or as the EU Commission called it some years back, the SBBBS, you can also pronounce it SBIS, where you pool essentially a lot of these EU-wide sovereign bonds. So each country has its own government bond, and you pool them, and then you tranche them to issue a senior bond and a junior bond. And through the tranching, you make the senior bond extra safe. Whenever there's a loss, should there be any default in any of the national bonds, it will be absorbed by the junior bond first, and only when the junior bond is wiped out, then there will be the senior bond will be touched. So it's extra safe. So of course it requires that the regulatory requirements are changed, so the senior bond is considered as a zero risk weight asset from a bank regulation perspective. But this way you could create a huge European safe asset market, which could then complement the US Treasury, just in case if the US Treasury would step back from the global safe asset status. And it also would have the advantage that the global safe asset supply would be less asymmetric, so it would be more equally spread across the globe. So whenever there's flight to safety, it would not only be, towards the United States, it would also be towards Europe, and also from the junior bond to the senior bond. So rather than having cross-border flight to safety, you have a cross-asset classes flight to safety, which then stabilizes the global economy. Now, of course, we move to this transition phase. So we have a global order, very much a multilateral order, a rule-based order, and we move to a global order which is bilateral, so one negotiations, and a transactional order, or unorder in a sense. And this transition is a radical shift from the old global order to a new global order, or more fragmented order. And it's not guaranteed this transition will actually occur in a smooth way. It could actually happen through this J-curve. And the danger is if the J-curve is very pronounced and hits a tipping point, this might actually derail the whole global order and it might not come back. The similar is the transition if we move away from an order which is, as a safe asset, the US Treasury is the key, and now it actually moves to a world where there is more fragmented, more different safe assets or no safe asset, and then we have to watch out that we don't hit any tipping point. So that's essentially my few opening remarks I wanted to make today, and then I give the floor and the mic to Thorsten Slok, who will actually tell us first about the more real economy side, and then he moves on to the financial economy sides. Thanks again, Thorsten. It's great to have you.
Thanks so much, Marcus. And thanks so much for everyone for joining us today. So let's share my screen here and have a look at the presentation that we put together for this. The way the presentation is organized is that we will first, as Marcus mentioned, talk about the real economy. Then we'll talk about the incoming economic data. And the reason why we do that is because, of course, more recently there's been some slowing in the data. Specifically, there's been some slowing in the soft data. As the employment report last Friday showed, we have not quite yet seen a significant slowdown in the hard data, but we will look at a number of different indicators that, of course, most of them are before the announcement last Wednesday of tariffs on a lot of countries. And finally, we'll turn to a very important part of this discussion, namely what has happened in financial markets over the last week or so since the announcement of tariffs on most of US trading partners. I will run a little bit quickly through number one and also number two, so that we can get to number 3 and discuss the market reaction. And if we have time, I'll also be sharing my Bloomberg screen and we can see real time here what financial markets are doing as we speak, because things are obviously moving very quickly at the moment. So let's first look at the broader backdrop for what's going on with trade. This chart here shows you world trade with the US and China in the year 2000. And as I've written in the text box to the left, blue denotes a higher share of trade with the US, and red denotes countries that had a higher share of trade with China. Obviously, in the year 2000, just around the time when China entered the WTO, trade in the world was mainly, for the comparison of China and US, was mainly relative to the US. Fast forward to today, you can see the chart has changed dramatically. The vast majority of countries in the world now mainly have China as their main trading partner. So this is an important backdrop for discussions around how has the world order changed, how has global trade changed, that we went from in 2000, a world where most countries were trading with the US, and we now have a world where most countries are trading with China. One other important statistic when it comes to global developments is to look at how much of Chinese exports go to the US. And this has also been through quite a significant change. As you can see to the left in this chart here, in the year 2000, 22% of Chinese exports went to the US, and now we're down to 15% of Chinese exports go to the US. So that's an important reminder that China also exports to other countries, including, of course, Europe, but of course also other countries in Asia, including, of course, also Japan. And US is making up a shrinking share of Chinese exports over time. Another way of looking at the backdrop for what's going on is, of course, to look at US trade. Who are the main trading partners for the US at the moment? And what you see in the bar to the left is the US imports. As you can see, roughly in very round numbers, 40 or 45% of US imports come from Canada, Mexico, and China. And if you look to the right, you can see that of US exports, it's about 40% that go to Canada, Mexico, and China. So it tells you very importantly that Canada and Mexico and China are very important trade partners for the US. For Europe, there's also an important dimension when it comes to trade, namely the difference between goods and services. And what you see in this chart here is, in the green bars, European imports of goods from the US, and the blue bar is exports of goods to the US. And you can quickly see in 2024, which has been the case all along, that the US exports more goods to the US than it imports. This is very different for services. This is the European Union's trade with the US when it comes to services, and the green bar, as you can see, is imports of services from the US, and the blue bar is exports of services to the US. Why is this important? Well, this is, of course, also very important when it comes to discussions around how might the Europeans retaliate to US tariffs. Because the focus of US tariffs is entirely on the goods side, whereas for the Europeans, it is the case that their trade balance is the reverse when it comes to services. So this is, of course, a very different situation in services relative to what you have in goods. And if we step back a bit and look at the broader question of, well, what is the share of exports of goods and services in world exports? In other words, which countries is it that are exporting more, and which countries is it that are exporting less? In this chart here, you see that the obvious answer, as we all know, is that in the dark blue line is that China in the 1990s came from basically making up a very, very small share of world exports to now making up a much more substantial share at around 12-13% of world exports. But what's noteworthy in this chart here is that the US in the light blue line has been shrinking as a share of world exports. But that is also the case for Germany, has also been shrinking as a share of world exports. So in that sense, who is the main exporter in the world? It is obviously China. And it is the case, of course, that Europe, US, most of the OECD area have seen a decline in their shares of world exports. That's not surprising, given, of course, the European countries and the US are now seeing growth coming not so much from exports. Maybe in the case of Germany, there is some important growth from exports, but there's also, very importantly, also growth coming from domestic demand. So that shift in what is the source of growth is, of course, very important, also in particular in comparisons with China. Looking now at the issue of tariffs and non-tariff barriers, there's a number of different institutions, including the World Bank, in this case the WTO. There are also United Nations that are trying to rank different countries, of course, according to what is the level of tariffs. And it is correct to say that the US has a lower level, not today, but up until recently, a lower level of tariffs than what you have in many other parts of the world. But as Marcus was exactly just talking about earlier, it is normally the case that emerging markets have a higher level of tariffs than OECD countries such as Europe and the US. And why is that the case? Well, that is often the case because emerging markets generally have fewer industries. So there is generally a tendency among governments to protect the few industries that you have and therefore increase tariffs relative to the rest of the world. If you have very diverse economies such as the US, a very diverse economy such as Europe, then there is less need to protect specific industries as such. So that's why, generally speaking, one important reason why tariffs have been higher in emerging markets is that emerging markets tend to be focused, for example, in the commodity sector, and therefore there are tendencies to protect that sector against competitive forces from outside. If you now look at the same question when it comes to non-tariff barriers, there are a number of different ways that this can be calculated. So therefore, this is just one way of looking at this. But specifically at the OECD, they have calculated the trade restrictiveness index, in this case for services, and it links the restrictiveness of trade with what's going on in the service sector. And the conclusion is the same. The US generally has less restrictions when it comes to services in terms of trade. Some, for example, in the green bar here, you see restrictions on foreign entry, restrictions on movement of people. There are various different dimensions to what is the way that the OECD measures this, but the conclusion is the same. It is correct to say that the US also on this front has had lower barriers to trade. If we then take a closer look at the US trade situation, it is also very important to lean back and ask, well, what are the goods that the US imports and exports? And there are, of course, a lot of different things that are sold into the US and the US sells to the rest of the world. But it really ultimately boils down to that the by far most important part of imports into the US is cars and car parts. And that's what this table is telling you. So the first column shows you what is the most important US import. And to the left, you see what are the different countries. And the most important import into the US from Mexico is car parts. The most important import into the US from Germany is cars. The most important import into the US from Japan is cars. The most important import to the US from South Korea is cars. Likewise from the UK, also cars. If you look at the second most important, third most important, fourth most important, you can quickly see a lot of the things that I have circled here tell you that cars and car parts are really a very, very significant part of global trade in goods.
How important are cars relative to pharmaceutical products? In particular, coming from Denmark, you probably should have
absolutely. So pharmaceuticals, of course, also play an important role, and you do exactly see that. For example, Germany, pharmaceutical preparations do play, and also here medical equipment also plays a very important role. So you're absolutely right, and there are certainly countries such as lovely Denmark where pharmaceuticals play a bigger role. But that's an example of that. There are some countries that are specializing in different things that are therefore trading with the rest of the world because they have been very good and become very good at doing the things that they do. And the other dimension in this discussion is also something that's very, very important to remember when we talk about global trade. And that is what is called related party trade. That means that I may have, as a company in the US, some factory in China or in Mexico or in Canada. And if I now trade with my own company, that is me basically importing goods that I have produced myself somewhere else. And if you look at the foreign value added in gross exports, you can again see that for autos, a lot of the value added in exports of US autos, around 20-25%, is actually imports. So this is the usual thing about autos, that auto manufacturing, in many cases, cars that are produced for consumption in the US, and also for exports abroad, they go across the border to Mexico and across the border to Canada 4 or 5 times. And therefore, the import content in your exports is also very elevated. Why is this important today? This is just an illustration of how highly integrated supply chains are, and therefore that if you do impose tariffs, that this is going to have, of course, some very significant implications, especially, of course, on the auto sector, because it is so highly integrated with the rest of the world. And finally, just a few more charts.
What happens, a lot of German car producers, they produce sedans in Europe and ship them to US, but SUVs are produced in US and shipped back to Europe. And if, of course, in the future, what will happen, that they will produce SUVs and sedans in Europe and in the United States. Do you have any idea what the extra costs are that you have to produce both types of cars in each continent?
I do not, but I can tell you a number of different statistics that 99% of sneakers sold in the US are produced abroad. 95% of t-shirts sold in the US are produced abroad. You can also think about that if you look, for example, at your Ford F-150, the average car that's produced in the US has about 30,000 components. For the F-150, roughly half of the content in an F-150 comes from Canada or Mexico. So think about it, if 15,000 parts in a car now needs to be produced in the US, it may be possible to find some substitutes for those products that are today produced in Canada and Mexico. But if you need to build factories where this is happening, this is, of course, going to be much more complicated. So the conclusion is, in my view, it looks like did we lose Marcus here? But the conclusion is, in my view, that we have a situation where it's just very, very difficult and very complex to get to a situation where we have that it will simply be easy to produce those goods at home that are today produced abroad. So with that, let's just turn to, I know we lost you for a few seconds, but you didn't miss much. So let me now turn to the next issue here. And that is, of course, this very, very important issue, which is part of the debate around why is it that we have gotten to the point where the global economy now is so integrated, and importantly, why is it we've gotten to the point where manufacturing is making up a smaller share of total employment. This chart here shows you, importantly, what is managed share of total employment economy. And if you go back to World War II, in very round numbers, manufacturing made up 40% of total employment. What's really noteworthy in this chart here is that this has been on a very steady decline until basically today, with even some flattening out since 2010. So there is an alternative theory out there that says this is not the case, that it is necessarily only China that has replaced US manufacturing. It could also be that US manufacturing simply has been so extremely productive that they have managed to produce so many goods in such an efficient way with much fewer workers. And that's why this trend line has been going almost down in a straight line since World War II. So this is important for the debate around, was it China entering WTO that is the source of why manufacturing jobs have disappeared in the US? Or is it simply the case that this is also a combination not only of that, but also a combination of productivity in manufacturing in the US being so much better and so much more efficient relative to what you see elsewhere? And turning to the tariffs, and of course what Trump has been doing, this chart here shows you the average tariff rate on all imports. And of course, the historical backdrop here, going back to 1821, is that yes, we are not at levels of where we were in previous episodes when tariffs went up, but it is obviously very clear that this is a fairly dramatic increase in tariffs relative to what we have seen before. So with this backdrop, it's not surprising that the Economic Policy Uncertainty Index has moved very substantially higher. Specifically, the Economic Policy Uncertainty Index, this is a measure created by Baker, Bloom and Davis, which are 3 professors that basically essentially read news and ask the question, what are we talking about in the news in terms of policy areas when it comes to economic policy? They have measures for immigration, tax policy, trade policy, healthcare, and when you combine all these together, you get this indicator here, which shows you that economic policy uncertainty, especially for trade, is very elevated at the moment. That's not a surprise, but this is just a quantification of this issue that we are seeing much more uncertainty, especially at the moment, of course, when it comes to trade policy. That's only the
index for trade alone, or trade policy alone, I guess.
This is trade policy alone, and in a minute we will look at that overall uncertainty. We'll look at in a minute, correlated together with investment grade credit spreads to see are investment grade credit spreads traded together with uncertainty, or have they gone up less than the overall level of uncertainty. But you're right, this is only for trade policy. And finally, also one other very important when it comes to thinking about trade is to think about what is the impact on different states of a trade war. This chart here, if you look at the text below the title, shows you the value of Canada and Mexico, exports plus imports, divided by state GDP. So as you can see in Michigan, if you look at Michigan, the number is 21. What does that mean? That means that if you take what is the total value of what Michigan exports to Canada and Mexico and imports from Canada and Mexico divided by Michigan's GDP. And it is very high at 21%. And why is that the case? That's of course the case because that's where all the auto manufacturers are. But you see also in Montana, North Dakota, New Mexico, Texas, Illinois, even Ohio, 7%. I mean, you have some pretty significant impacts. If you impose tariffs on Canada and Mexico, then, of course, the states that are more dependent on Canada and Mexico are likely to experience more of a negative shock as a result of this. So that's, of course, why it is not only the case that this is hitting in what you and I buy in Costco or Walmart, it is also hitting very hard in the sense that those states that are more sensitive, and not surprisingly, it's the states that are across the border up to Canada. Of course, the states that are on the border of Mexico, of course, are the states that are, generally speaking, more impacted by higher tariffs on Canada and Mexico. And the last point, just to broaden it out, let's not forget, there's also DOGE happening in the background. And I know this is a little bit of a side issue, but it is important also when we get to the discussion of the economic outlook. Remember, there is often a debate around that, well, all government workers, they just work in Washington, D.C., but that's not true. If you look at federal employment at the state level, so 15% of federal employment is in Virginia, Maryland, and the District of Columbia, but 85%, as I've written in the title here, are outside the DC area. And when you look at this at the county level, this is federal workers as a percentage of everyone employed, not surprisingly, is very red in the DC, Virginia, and Maryland area. But you can see at the county level, of course, you also have fairly significant amount of federal workers because you have, of course, military, you have VA, you have across the board your park ranger in Wyoming, federal workers across the board that, of course, are living across the country. And why do I bring this up? Because think about it, there are one federal worker and there are for every federal worker 2 contractors. That means that for the total amount of federal workers is about 3 million. So we have about 6 million contractors. That means that the total amount of federal workers in total, according to Brookings, is about 9-10 million. So if now 10 million people are worried about losing their jobs, then it's maybe not surprising that you begin to see consumer confidence begin to erode, and that's what we'll see in a second. So the conclusion is, taking the uncertainty of the trade war, we don't know yet what the trade war will do to GDP. We don't know how companies will respond. Will companies take their current inventory and sell that at old prices? Will companies raise prices immediately? And we will therefore immediately begin to see positive impacts on, meaning higher prices across the country? Or will we basically see still goods being sold at old prices and then only gradually see prices go higher? We don't know what the company reaction will be going forward, but we do know that we are likely to see some negative impact on earnings, negative impact on GDP, negative impact on unemployment, and combining that with DOGE in the background or still working out and having a negative impact, of course, not only on employment for federal workers and contractors, but also on sentiment for consumers. This is, of course, setting us up for that the incoming data is more at risk, of course, of being to the downside. So let me now summarize our view on the economy at the moment, and I'll run through this relatively quickly, but it's clear that it's not only number 3, namely the negative impact of tariffs on earnings and GDP. We also have consumer confidence has been deteriorating. We'll look at those charts in a second. We've seen corporate confidence have been deteriorating. We also don't know in bullet point number 4, what is the negative impact of retaliation? How are the Europeans going to respond? How is the rest of the world going to respond? We still have to see what exactly the response is going to be from the rest of the world. On top of that, let's not forget, as we'll also just look at in a minute, that we have a $10 trillion decline in the S&P 500. The negative wealth effect from that alone is quite substantial. And again, as I just highlighted, those layoffs are of course also happening in the background. So taking all these 6 bullet points, admittedly, this is not particularly scientific, but this is just a way to try to figure out what are the headwinds to the US economy at the moment. I do come to the conclusion that there are a number of downside risks we can worry about simply because this combination of things is just beginning to drag down the outlook in, unfortunately, a fairly significant way. So let's just look now at a few of these bullet points. First, consumer confidence. The green line is consumer confidence for families with incomes of more than $100,000. The blue line is consumer confidence for families with incomes of less than $100,000 a year. And if you look at the green line, higher income households have seen a sharper drop in consumer confidence than lower incomes. But both of them have in the last few months seen consumer confidence decline. And there's another question from the University of Michigan survey where households are asked, what are your expectations to unemployment going forward over the next 12 months? And you can see now 70% of households are saying, I expect higher unemployment going forward. That is levels that we only normally see during recessions. That's not necessarily to say that this will be a recession. I'll talk about that in a minute. But it is at least saying that households are getting quite worried about the outlook given where their fears are at the moment about the unemployment rate going higher. And finally, there's also a question for consumers in the University of Michigan where they are asked, what are your expectations to business conditions? And you can see this is the percentage of consumers that say that business conditions will be worse. And 80% of households are now saying that they expect worse business conditions. And this was done before the tariffs were announced last Wednesday. Look at this. This is the highest level since University of Michigan began measuring this in 1980. This is obviously also telling you that consumers are quite worried at the moment. And turning to corporate confidence, this is a CEO confidence index. That's been going down. And another way of looking at corporate confidence is to look at corporate capex plans. There are surveys where the Dallas Fed, the Kansas Fed, the New York Fed, the Philadelphia Fed, they ask businesses in their districts, are you planning to do more capex? There's also the NFIB, and I see some of the labels are missing a bit here, but also, of course, you have the CEO survey from the Roundtable. And all these lines, as you can see, when Trump got elected, you basically saw in December and January, capex planning went up. Companies were saying, we are planning to invest more. Our capex planning is to expand more over the next 6 months. But you can see the last 2 observations for February and for March have really sharply reversed that trend. And now companies are saying, well, we are beginning to at least have some caution, at least relative to where they were in December and in January. So this is also telling you something about that companies are becoming a little bit more worried about their capex plans, at least relative to where they were in December and January. So let's now turn to the financial market reaction we have seen more recently. The broader backdrop for what's happened in financial markets is, of course, first to look at capital markets and how capital markets have responded to the uncertainty that has come along in the last few months. And capital markets, of course, is a different way of saying financing for firms, financing for institutions that go to the capital market and borrow some money, that go to the capital market and do IPO, or go to the capital market and do M&A. And you can see here, this is loan issuance. And we can discuss this in more detail, but you can see very clearly issuance of loans has been going down in the last 2 months from a fairly significant high levels, both in the month of December and January. IPO activity has also been going down, and M&A activity has also been going down. So one way of looking at this is that when uncertainty is elevated, it does begin to make it more difficult for anyone with a model of trying to value a company today. If I don't know what earnings are going to look like, if I don't know what interest rates are, if I don't know whether this company can sell products or buy products the way that they did, then the level of uncertainty goes up. And as a result, capital markets activity has gone down. Turning to the stock market. Of course, I know these data I'm showing you here moves literally every day, but where we sit right now, the total value in the S&P 500 since the peak on February 19 is now down around 10 trillion. And Obviously, this is not adjusted for inflation, but it is quite noteworthy that this is roughly the same amount of value that was destroyed, or the drawdown that we saw during COVID. Yes, I understand inflation in round numbers is about 25% higher, or the price level of things in CPI is about 25% higher today than what it was during COVID. So yes, maybe it is a little bit less than what we have here, but let's of course continue to monitor this, because this is a new effect that suddenly comes in addition to everything else we've talked about in terms of the wealth effect that is now going to be negatively impacted consumers and consumers spending. If we now turn to your question, Marcus, about, well, what about the broader measure of economic policy uncertainty? That's the green line here. The green line shows you the measure of economic policy uncertainty that includes all types of policy, not only trade policy as we looked at earlier. And what we have done in this chart here, and I'm embarrassed to show everyone on the call here this, because this is embarrassingly simple, but it is at least the case that this has been somewhat related historically with the blue line, which is the investment grade corporate bond spread. So the investment grade corporate bond spread is the spread that investment grade companies pay above US treasuries when they go and borrow in the market. And as you can see in previous episodes, and I know it's difficult to do comparisons with COVID, it's also difficult to do comparisons with 2008, but it is quite noteworthy how much uncertainty has gone up and how little credit spreads have gone up. In other words, credit spreads haven't really widened much. So you could either have the view that the blue line has to go up a lot more, or you could have the view that the green line is about to come down. One way of looking at this is that the green line is probably more the soft data, meaning the fears, the worries about what's coming, whereas the blue line could be viewed as the hard data, meaning earnings for corporates, meaning the hard data has not really slowed down quite yet. So if that's the case, it becomes very important to have a discussion. Do we think that the soft data will eventually slow down the hard data? And if that's the case, of course, the blue line should be going up. Or if you think that the green line is about to come down because now tariffs will be going away, let's say with someone thinks that tariffs will go away next week, of course, then the green line will be coming down and we will no longer have this level of uncertainty.
It could also be that, that corporations are less levered now compared to 2008 or COVID. Is this?
That is correct. So credit quality. Yes, so a very important part of that question, there are two dimensions to this. So leverage generally in the investment grade credit index is generally better and higher quality. The only issue is that the IG index now has more triple B than it had before. And that means if 50% of the IG index is triple B, that does mean that at least from a ratings perspective, IG is slightly lower quality than what it was, say, even 5 or 10 years ago. But you're right, there's a number of dimensions also. What are the contents of the index? And is the contents of the index, and including whether it's tech or not tech or healthcare, or what parts of the index is it that are more vulnerable at the moment in the current environment, given especially, again, what's happening in the stock market.
Is there some lead-lag relationship between the uncertainty index and the spread, or it's complementary?
So I have not done greater causality on these two series on each other. This is a great project for someone to look at. I think this is an important point because it is, of course, the case that you begin to worry about what does high uncertainty mean and what could the implications be for companies. And if high uncertainty means that companies hold back, if that means that we as households hold back with saying maybe we're not buying a new car, maybe we're not buying a new washer and dryer, maybe we're not buying an iPhone. And if companies begin to say, well, and that's what we literally find out in the coming weeks, if jobless claims, which is the unemployment numbers, which come out every Thursday at 8:30 a.m., if that begins to move higher, we will begin to find out if companies are saying, you know what, I'm stepping back with hiring because there's just so much uncertainty. And that's why we will soon find out the answer to your question. We are literally at an inflection point, in my view, between can the soft data continue to be so weak as the green line here? Can we continue to have this extreme level of uncertainty without any impact on the hard data? And another way of looking at this is also, just like we looked at the stock market is down a lot, of course, is to look at what is the level of high yield spreads and investment grade credit spreads. So the blue line here is the high yield spread, and the dotted blue line is the historical average for the high yield spread. And what's quite noteworthy is that despite that we just saw the stock market is down 10 trillion, which is really telling you that the stock market is saying we're about to get a recession, high yield spreads in the blue line are not even at the historical average. So that's another way of saying that there is quite some discrepancy between the narrative in equity markets is that, wow, things are about to get really bad. Whereas the credit market, as you can see here in the blue line, is saying, there's a good deal of complacency. Maybe things are not that bad. And of course, you see this also when you look more closely at the credit quality spread between triple C and double Bs, which is what you see in the green line here. So that is the difference between the level of interest rates on CCC bonds relative to BB bonds. And yes, it has widened out in the last few weeks, but look at it, we're just at a level of where we've been for the last several years. We're not at COVID levels. Unfortunately, the data doesn't go further back than 2018, but it's very clear that even when it comes to the quality spread, which normally gets attention, it's not the case that this is flashing red and telling us that there is a recession coming, at least not from credit markets. So another way of doing this, and this is not particularly scientific either, but it's just to try to figure out what is the difference between what the drawdown has been in equities relative to the drawdown in high yield. And you can see the red dot over there, the stock market is down around 17%. And again, in a not very scientific way, but if you draw the trend line in the black line, you can see that high yield, normally when the stock market is down 17%, high yield is trading at like 900. So this also raises a lot of questions about what is the story and what is the reason why high yield is trading in a more complacent way relative to how equities are trading.
So typically it's actually the credit market is a better predictor than the stock market about future recessions. Would you agree with that? Historically?
I would generally agree with that. And one important thing that we haven't talked about for the stock market is, of course, the stock market is dominated by the Magnificent Seven. So if the Magnificent Seven partly have had weaker earnings, which is an important reason why they have adjusted. Remember, the Magnificent Seven make up roughly 35% of the S&P 500. So of course, if the Magnificent Seven basically has seen some slowdown, then of course, in earnings, that's a very important driver. And if also now maybe there are some fears around the Magnificent Seven when it comes to retaliation, what is Europe going to do in terms of services? That could also potentially be a reason why people are more worried about Magnificent Seven. And finally, Magnificent Seven also play a very important role when it comes to risk parity models, simply because they have been, of course, doing so well and getting a bigger and bigger weight. And with that conclusion, high yield index is not here in this chart here, of course, the Magnificent Seven. So in that sense, it may also simply be that the baskets that we put into how we define the index of high yield is different from how we define the index of the S&P 500. And finally, turning to rates markets and interest rates, and this is, of course, the debate that we've seen more recently. What really is noteworthy also is what's been happening in the last few days. Think about it. Normally, when the stock market goes down, interest rates also go down. But that's not what's happened in the last few days. Despite that the stock market has been going down, interest rates have actually been going up. And you saw in particular on Monday, it ended up that we ended the day on Monday in equity. So here on the y-axis is the daily moves in the S&P 500, and on the x-axis is the daily move in 10-year interest rates. But you saw 10-year interest rates go up repeatedly here, of course, in the last few days, despite that the stock market has been going down a lot. So this has raised a number of different discussions around what could be the reason why interest rates are going up when the stock market is going down. And maybe, I think we spoke about it. Let me stop sharing this screen here and maybe I can share my Bloomberg screen.
TIPS rate, because it could be inflation expectations moving primarily.
That's exactly right. It could be a number of different things that could be the source of this. So forgive me for this switch here in screen, but this is very important just in real time to take a look at what are the movements in financial markets that we're seeing at the moment. So let's do this slowly and look at this very carefully. This chart here shows you what is happening with 10-year interest rates at the moment. As you can see, 3 days ago, and here we're talking about, of course, the beginning of this week, interest rates started out at 390, and now we are up to 340. In other words, we have had a 50 basis points increase in 10-year interest rates in the US. So this has raised a number of questions around why is this happening? The first area you can look for a discussion of why is this happening is, of course, to look at, could this be foreigners that are selling US treasuries? And the reason why I'm skeptical of that explanation is because when you look at the dollar, which is what you see now, this is the DXY index on Bloomberg. This is just the dollar index. And it doesn't look like the dollar has fallen a lot. It's fallen a little bit today, but it doesn't look like the dramatic steady increase we've seen in interest rates was associated with a steady decline in the dollar. So that's another way of saying it doesn't look like this is foreign central banks or foreigners selling US treasuries. So in my view, it is not the case that US exceptionalism is being challenged. At least that's not what's been driving this move here. Instead, what more likely could be the driver of this is the significant issue that's been going on with equity markets that has been hitting VIX and therefore options markets. The VIX, which, as you know, is the implied measure of volatility in equities, remains extremely elevated and has, as you can see, in particular yesterday, been fluctuating wildly and now gone up to a level where we're currently at around 50. Normally, VIX is in the range of 10 to 15, so this is highly unusual. So this tells you that it's probably not foreigners that are selling treasuries. It's probably a second explanation, and it's probably risk reduction. If I'm a portfolio manager and I own equities, I own credit, if I begin to see losses in my credit portfolio, if I begin to see losses in my equity portfolio, if I need to raise cash, in particular if I had some bets on that were levered, I can immediately go to rate markets. And in rate markets, I can get there very liquid. I can immediately raise some money that I can use to try to cover some of my losses or my margin calls on the credit side or on the equity side. So I'm guessing simply because VIX is so elevated that an important reason why long-term interest rates have gone up is simply because of risk reduction and therefore simply because of portfolio managers that have other things than just interest rates have simply had the need to raise money very quickly to use that money elsewhere in their portfolios. And the final point, why is it that rates could be going up?
Because normally there would also be a flight to safety element to it. So if the VIX goes up, you would like to go in the US Treasury and actually yield will come down. But you're saying there's now a shift away from the 10-year to a short end of the yield curve, so people want to hold cash rather than a 10-year.
Exactly.
So you see a shift along the maturity structure.
Yes, so that's exactly why a lot of money has moved into the front end of the yield curve. That's my best estimate of what's going on. Exactly with the idea that T-bills and front end rates and even munis are a good place to hide while you wait for this storm to ride out. And the last thing, of course, in this discussion, as you and I, Marcus, talk about often, is, of course, the basis trade. And the basis trade, of course, is the simple trade that you buy the difference between the cash bonds and futures, and that small spread has been not totally stable, but relatively narrow in a range of 5 to 10 basis points. Hedge funds have that levered on. In some cases 50 times, or some cases you also hear 100 times. And of course, if that's very levered and you do have margin calls or needs for risk reduction, then that would also involve hedge funds selling their cash treasuries and therefore also putting upward pressure on long-term interest rates. So the conclusion is we are still in the market and everyone else is trying to figure out what is the situation in terms of why is it interest rates are going up. But I would still come to the conclusion that it is probably not quite foreigners selling US treasuries. It's probably more risk reduction among domestic asset managers, and it is probably also to a significant degree an unwind of the basis trade. So with that,
do you have any data on the basis trade, the exposure of the hedge funds? Is there any data on Bloomberg or anywhere else? You can, or the
unfortunately not.
Can you see it somewhere?
No, I have not been able to find that, and I'm not sure if that even exists. So it is just very, very difficult. And that's why a lot of this does become circumstantial evidence. And forgive me, I do know that a lot of the things I'm saying is conjecturing and somewhat guessing, and excuse me, arm waving. But I think when we take the different screens together, I do think that it points in the direction that it does not look like it's foreigners selling, and it looks more with a high volatility like it's someone is moving portfolios around domestically. And on the basis trade, at least given the magnitude of the moves, at least of the somewhat similar size relative to what we saw in COVID in March of 2020. Remember, during COVID in March of 2020, the Federal Reserve was every day at the peak buying $100 billion in treasuries in the market simply because there was so much unwinding going on. And I should also have mentioned from the beginning, the magnitude, what we do know to your question, the magnitude of the basis trade is that it is roughly around 800 billion to $1 trillion, at least in the latest data that is published. So if that, of course, is now being unwound, that, of course, should be coming down. But it's very clear that that type of $1 trillion in a levered trade is obviously something that could potentially be the source of what's been going on.
So there's of course a take by Anil Kashyap, Jeremy Stein, and others who wrote recently a Brookings paper arguing that the Fed should step in if the hedge funds have to step out. Or do you have a take on that?
Yeah. So this is also very important. So there was Brookings papers on economic activity, which was here 2 or 3 weeks ago, where Anil presented exactly the paper where they had written about the basis trade. This was before, obviously, what's happening in the last few days. But their suggestion was for the Fed to build a facility that could try to deal with some of the challenges that comes exactly in a situation basis trade has to unwind. So this was very important and continues to be a very critical debate. But given what's happening at the moment, I feel very sure that there's a lot of people that will be studying what's happening in financial history these days, exactly to try to understand what was it that happened. Was this the basis trade? Was this just risk reduction among managers? Or am I wrong? And maybe it was the rest of the world. So let's not forget the footnote on the rest of the world is if I'm a China or if I'm a foreign central bank, I could also have treasuries in custody holdings in the US and sell that and keep the money in dollars without taking the money back to my home country. So if that's the case, we would not see an FX effect. So there's just a lot of different data that needs to be looked at, and with the historians and anyone who does the hard work of figuring out exactly what's happening these days here will, of course, come up with some answer to exactly your question, namely, is there a need maybe for facilities to try to dampen some of the risks that come with a situation such as this one? And the last point, I'll just skip a few pages quickly forward here and just get to the conclusion. But the last point I just want to highlight is that in my view, and I do think based on everything else we've talked about, if the starting point is that tariffs are not going away, and we've not talked about that, but let's just assume that if that's not going away, then we will see a negative hit to earnings and inflation coming. And that's, of course, why markets are so turbulent, because it's extremely difficult to quantify in any spreadsheet what that hit will look like and what the nature is and how long time it will last. And will it last 4 years? Will it only last a few weeks? No one really knows. We just know that this is a starting point, that tariffs are likely not going away. And as I spoke a lot about, correlations breaking down across equity rates and credit markets. And number three, very important, we've not talked about the Fed, but let's not forget that the Fed does normally not respond to lower stock prices. Imagine if the Fed cut interest rates tomorrow and said, ooh, the S&P is down to 20%, we need to cut interest rates. Well, we could potentially begin to see deals with Europe, deals with Canada and Mexico, and the stock market could go back up to 20%. And suddenly the Fed cut is going to look like a mistake. So that's why the Fed is likely waiting now for the unemployment rate to see whether that's going to go up. And then that could be a reason to begin to cut rates. Or as Jay Powell talked about last Friday, the dual mandate is the dual mandate. This is 2% inflation, full employment. If that starts moving in the direction of saying the Fed should be cutting, then of course they will be cutting. But the final point on the Fed is the textbook would tell you that a trade war means higher inflation, lower GDP. And what should the Fed do with that? Because higher inflation means you should be hiking, but lower GDP means you should be cutting. So which one is it? And which one will the Fed put weight on? The risk is, of course, that we get a very significant situation where inflation just continues to go up a lot. Some estimates have that inflation over the next 12 months will go up as a result of tariffs by 1.5%. And GDP could go down by 1.5%. So therefore, the Fed will need to decide what do they put weight on in their dual mandate, on inflation going up or on GDP growth going down. So the bottom line, in my view, is there's significant uncertainty about the coming impact of tariffs on earnings and how long time it will take for tariffs to come down because of deals made with country. Maybe we will have deals. Navarro is saying we will not have deals. There's a lot of discussion around this. But if there are deals, then of course, and tariffs do come down, it will make a difference. And let's not forget, those is also pushing the unemployment rate high in the background. So I do worry still that there's more downside risk to the S&P 500 and to low quality credit. And one absolute main conclusion is that volatility will likely continue to be high.
So can I ask you, of course, if you put yourself in the shoes of the Fed, it also matters how strong is the inflation expectations anchor. No? Before we moved in this high inflation period last time, people had a very strong anchor in their head, and hence, you could come back more easily. But this time around, the inflation anchor is not so pronounced anymore, so the inflation expectations might shift much more quickly, making it much more challenging for the Fed to go this way. Although essentially,
absolutely. So that is exactly
supply shock.
100%. So if the Fed decides to go with growth is slowing, so we have to cut rates, they absolutely have to communicate about what is their view on inflation expectations, because then they need to say we are cutting interest rates because we feel comfortable with where long-term inflation expectations are. The problem a little bit more recently is that University of Michigan inflation expectations have actually been moving up and been moving up quite significantly. So this is now opening up a discussion around should they then look at TIPS break-evens, which have been relatively stable and well anchored, or should they look at surveys of measures inflation expectations, and surveys of measure of inflation expectations have remained quite elevated, in particular in the last few months. So if suddenly it's the case that they focus more on break-evens, of course, they are now then saying, okay, it's break-evens, that's the right measure, and therefore we can allow ourselves to cut interest rates. But this is a very challenging environment, obviously, and in particular, of course, now with the discussion, including from Trump and others, namely, hey, should the Fed cut rates now? Should they cut rates later? And there's also a very important part of that debate is, remember, Jay Powell's term runs out in May. Adriana Kugler steps down in January, so whoever gets Adriana's job might become the next Fed chair. So we might already in the next 3 to 6 months figure out who the next Fed chair is, which also will become potentially important for a discussion around, will that new Fed chair put weight on inflation or put more weight on growth?
Okay, so you indicated earlier that actually the 10-year yield went up 50 basis points, or half a percentage point. What's about the tip rate? So is it mostly about inflation expectations, or is also the real rate went up significantly as well? And just to isolate what's an inflation effect and what's really the real growth expectations of the economy and the risk premium and other components.
Yeah, so that's very important. So break-evens are going down. In other words, if you look at near-term inflation expectations, of course, is higher. But when you look at what is long-term expectations, the message has clearly been that the market is that in the long term now we expect inflation to be lower. Expectation is that growth is going to slow down. Some very important nuances in your question about in the short term, people are expecting. Oh, I see Trump just posted that he's authorizing a 90-day pause on reciprocal tariffs. Okay, well, that doesn't change our discussion here. But talk about real time. I see it's up 8% here. But the conclusion to your question is the same. That there is still a lot of discussion around, is inflation going to be up in the short run? Yes, that might be the case. But the Fed can then rely on long-term inflation being low and saying, hey, we now have the long-term inflation expectations are well anchored. So with that, we can be cutting rates.
So I have two more questions. One is, how big is the component of the uncertainty in the policy arena rather than the tariff itself? So let's suppose we impose a certain tariff, but we know this is now the tariff and we can plan with it and companies can work around it. How bad would that be to a world we live now where there will be, we know there will be, there's a lot of policy uncertainty. Can you quantify this in GDP numbers or any indication? And my second would be, let's suppose we impose a huge amount of tariff. How long will the economy take to adjust to this new equilibrium steady state? Is this a 1 year, 2 years, is it a 10-year horizon until we need? And do you have to talk to some, real CEOs and of real companies saying, okay, we have to readjust our supply chains this way, and it takes us 5 years or it takes us 3 years. Typically, we can do it faster than typically initially we think. That's at least our experience from COVID.
So on the last point, of course, the time it takes for reorganizing your entire economy so that your supply chains are no longer dependent, with the example I gave about cars and sneakers and t-shirts, etc., that's going to obviously take many, many years. So the result of that, of course, is that the implications are that you could ultimately have a period where it would be a long, long time before you begin to have the onshoring or homeshoring, if you will, of that production. And of course, it raises a lot of questions for the CEOs who are, because if you have a situation where companies are suddenly saying, well, but are these tariffs going to stay in place? Are they not going to stay in place? Are they going to be different next week? Are they going to be different in 3 weeks? I mean, this just becomes a very, very important debate around how do you react as a CEO in a corporate? And I would say this is just such a complex question that it is very sector specific. It's also, for that matter, very specific to even what parts of the supply chain you are, even within autos, whether you think that this is needed and whether your competitors are in your home country, other countries. There's just so many strategic decisions going into this that makes it just very, very difficult to quantify. So yes, I do have a version of FERPUS, the Fed's model of the US economy, and I try to give a shot to that and ask the question, okay, if I see, in this case, for example, the dollar going up, which could be a proxy for trade war, or if I put in, say, Doge at the same time, that $100 billion savings in the federal expenditures, then that could, of course, be something that could be quantified over time in the model. But the short answer to your question is we are just not able, I don't think anyone really is able to quantify what the implications are of such a significant shock.
You also have an uncertainty shock, or?
I do also have an uncertainty shock. So what I did do, and now I'm a bit embarrassed to show you this, but what I did try to your question is here. Let me see if I can pull up the presentation again. But what I did try to do was to look at Okay, I can. Oh, here it is. I did try to look at in a very, very embarrassingly simple VAR, and I'm very embarrassed to show this to you. But what I did try to do was to ask the question, let me build a VAR model, vector autoregression, let's do impulse response, and let me try to investigate the consequences of a temporary shock, which is the blue line, and the consequences of a permanent shock. We tried various versions of this with many more variables, and you can say, well, I want to have policy uncertainty, now that we have a quantified measure of that. I want to have GDP. You could also have done this. We only end up with those two variables, which makes this even more embarrassing. But we tried to do also variants with inflation. We also tried to do with the exchange rate, all the things that you think are the dominoes in between uncertainty and GDP. But they basically all came out roughly looking similar like this, that if you have obviously a more permanent shock, it will have a more permanent effect on GDP, and therefore the uncertainty staying higher for longer is something that most papers and most studies do show that this exactly comes with a bigger risk, of course, of therefore a deeper slowdown.
Okay, thanks a lot, Thorsten. We keep watching as events unfolding, and as you said, there was just a major U-turn, or at least a pause put into place on the tariffs, so we will see how the markets will react, with the stock market and the credit markets, and hopefully the real economy will readjust to a new equilibrium very fast.
So far now we tried this experiment for 1 day, so we'll see. There's a 90-day delay now, and I see the S&P is up by 6-7%. So it looks like at least for now, it looks like things at least are not what we thought they were just when we started. Okay. But thanks so much for having me, Markus.
It's hard to predict the future, as people say. Thanks a lot, Thorsten.
Thank you.
Soon.
Bye-bye.